Welcome. This is Notes from a Napkin, a sub-show version of the Critical Point podcast. It's where I can get a chance to kick back and discuss a variety of things that can impact our markets, but more so maybe what's impacting our economy, what's going on in our lives. And someday maybe we'll have guests on this part of this type of show to help out here, give us ideas of what's going on in, say, a long-term to super long-term basis. So I may discuss climate, I may discuss politics, religions, and economy, various news events that might be impacting anything and everything, and a little less of the scientific modeling side, the quantitative side. Okay, I want to start this show, and this is May 28th here. This Notes from a Napkin might be a monthly kind of release, we'll see. But we're going to start today on this show with a chart, a line chart of nominal GDP per capita. It shows the value of the economy per person. It's showing the dollars worth of the economy per person. Okay, and what I want to point out is that from the 1800s all the way into the 1920s, before the big crash into the Great Depression, that nominal GDP per capita grew about 1,000%. Sounds pretty impressive, but when you stop to think about that it was over 100 years, it's not such a good performance, and then it becomes even less so when we look at the performance from the Great Depression to today, okay, which was about 10,000% if I did the math, and I haven't updated this in a few years. In the sense of performance, this chart actually is updated through 2019. Now, if you want to follow some of this data, I'm getting it from measuringworth.com. Okay, back in the 1810s, one of the largest supercycle that I follow and is in the model is what we call a 216-year cycle. It's actually like 180 years, 220, 230 years, a pretty wide ranges with all these cycles, okay? And applied my name to it after putting in so many thousands of hours of research back in the 2000s up to the date, building the model and tweaking it and adding to it. Now, in the 1810s, it was almost like one thing after another topped out. The economy, commodities, dollar, interest rates. If they weren't topping out, they were bottoming out, meaning an inverse relative to something else. It was just interesting, and the stock market even come down. Now, GDP fell about 48%, okay, during the 1800s, 1810s area. Now, the thing is, the stock market started to oblige, and then it bounced back, and we actually see in the 1820s when gold and cattle had bounced back, but peaked for that cycle in the 1820s. The stock market started down as well, then changed its mind a second time, came back up in the 1830s, and then peaked for that cycle, and then ran into trouble all the way into the Civil War. And as you imagine, everything just crashed in the Civil War. Our dollar crashed. The interesting thing is our dollar did not go any lower than colonial script for the U.S. as of the late 1600s. And now I find that fascinating. We respected a supercycle low, even though it was in its own supercycle bear market. Now, of course, some commodities exploded during the Civil War, and you got a supercycle reversal higher. Anyway, we can see the economy grew, and then by the Civil War, we see something like a 38% drop off a smaller supercycle top. Then it gets into 1929, and then finally it collapses into a 216-year cycle bottom. So a bit of a strange pattern. The 216-year cycle didn't work. Normally we'd say, okay, topped in the 1810s to 1830s, and it was downhill for the U.S. into the 1930s. And the interesting thing is that would have been the forecast had you made it back in the 1810s. You would have called for a bottom in the 1930s to 1940s area, or somewhere in the first half of the 1900s, okay? And it worked, except that the market or the economy actually made new highs along the way. So it was a distorted, disrupted pattern. And I do believe there is such a thing as a 100-year bear market that connects with a 100-year bull market that creates this 200-year cycle or 216-year cycle. But I do think over time, looking back, we have commodity indexes that kind of give us a gauge of the economy going back 1,000 years, and you can see we're systematically, methodically destroying 100-year bear markets, but we're keeping the bull markets, okay? But we're not necessarily increasing the length of the bull markets. But we are destroying, we just can't have that poor of economy for an entire century or something like that. Anyway, by the 1930s, we got tired of a lot of depressions that were seen throughout the 1800s. We had more recessions than depression, or more depressions than recessions, in my opinion, and we had one about every decade. Okay, and then of course there were panics in the stock market almost every decade. At any rate, by the 1930s, we strengthened the Federal Reserve. We got the government more involved. We did more money printing. We were basically saying, we've got to manage our economy a little bit. It can't just be the Wild West, anything goes. We're not getting anywhere, okay? And so basically, you can see our economy behave differently. Look at this. Just a subtle, quiet trend just keeps marching up in terms of nominal GDP per capita, in terms of our value. What is our economy worth, okay? Totally different characteristic, and isn't it fascinating that it came out of a supercycle bottom that's the largest that I'm aware of that fits in it. And I do believe there's larger cycles, but again, I think we're just destroying the bear phase. You can't see it. We're in exponential growth for a few thousand years, actually. Okay. So at any rate, here's your trend. We're in a supercycle. It's probably going to end the late 2030s to early 2040s, and we will be vulnerable to a 1929 crash. But I'm not forecasting that it will be a crash. We may do something to manage it so it's no worse than what we've seen in the Great Recession in 2008, 2009. Nevertheless, that could still be a 55% drop in the stock market. Okay, and we don't know what else we'll get out of this, such as revolutions, totally changing the country, where's capitalism going, and that's why I want to talk to this kind of stuff. There is some truth to these people talking about inequality. I am a capitalist. I'm not going to abandon capitalism, but I definitely believe we need to change it. We need to tweak it, that it needs maintenance along the time, that capitalism really doesn't work in the sense that has these disruptions, sometimes creative destructions, meaning there was some kind of good afterwards, but the bottom line is we have recessions and depressions. The system breaks down. I still think that's probably better in communism and socialism that also breaks down, okay? And I would rather see us change capitalism. I'd even like to go with a social capitalism before I'd ever go with a hardcore let anything happen type capitalism, because it always turns into capitalism pigism. It's always turned into autocracy relative to politics, and it's also turned into fundamentalists relative to religion, and we're seeing all these things working right now, and it turns a monopolistic, an oligarchy, and all the bad things you can think of to attribute it to capitalism, and it then eventually blows up. Well, the point is, if we just let it blow up, maybe you can come back with a little government support, bailouts, money printing, put it back on its feet, and it does just fine. But what if during that crash, people just say, we're just sick and tired of this, we want something entirely different? And what if it's not capitalistic in nature? I think that would be kind of sad, frankly, okay? So at any rate, what we've seen is the nominal GDP per capita has slowed down from 1980 to now. And that's rather interesting. I'll explain that in a moment. And then this was the better performance coming up out of the 1930s depression and from World War II on up in 1980. Now, some of these things I've labeled are just periods of how we think and behave and act, and I'm having a difficult time here trying to find positive, happy things. It's like everybody's under stress and everybody's nasty and mean is how this is developing, and I'm trying to mix in corporatism and other things. And over here we have various types of performance of investments that might go along with the performance of some of these trends in our economy. But look at the sustainability of our economy compared to back in the 1800s. It was like, yeah, we really didn't know what we were doing. And now we got it under control and have a stable economy. Maybe you don't like it being stable, but I think most people probably do. I'm not convinced we can handle the truth of runaway capitalism and recessions and depressions. And just, to me, I don't want to go there on a depression, but I like recessions. I do think that cleans up and fixes some things. And I'm a little concerned we're getting an attitude where we want to cancel some recessions. Okay, now I'm going to convert this chart to a rate of change. Let's see if this works. Okay, this is a 1-year rate of change, and you can also use a 10-year rate of change, and it shows the same thing. Pay no attention to these numbers. This is for some other types of research and has to go into that psychological and sociological and behavior kind of stuff. Okay, so what we have is from the Great Depression or from World War II I should say, we can see the rate of change was rising into about 1978, close to the orthodox peak of inflation, or I should say peak of inflation and interest rates of 1980. Now, what does this mean, rising rate of change? Well, what it was suggesting, especially from World War II, is what it's suggesting is our economy was speeding higher in terms of growth. It was getting larger, but it was doing it at a faster pace. So it was just flat out a bull market in the economy. And the weird thing is, some people, especially on the right-wing politics and capitalist side, want to paint that as not a good thing. Now, of course, we ran into too high of inflation. So I will explain these trends in a moment, but look what's going on now since 1980. The rate of change is in decline. Our economy is still growing, but not as fast. The pace of growth is slowing down. It's like our economy is tired. Now, what I want you to think about is, and I should have pointed this out on the previous chart, you can't really tell who was in the White House from these charts. You can't really tell who was running Congress, who was running the country, at least from a political aspect. You can't really tell the government impact more or less. And isn't that fascinating? We can't tell if we were liberal or conservative. It's like we're in some kind of engine where, okay, we're liberal for a while, we're conservative for a while, we're liberal for a while, we're Republican for a while, we're Democrat for a while, we're back to Republican, okay? And the interesting thing is, it doesn't seem to matter. We still work it all out somehow. And the economy just keeps getting bigger and bigger and bigger. It's growing. But we do have an issue that it's slowing down. And that's fascinating to me because even though the Republicans were in power 50% during this time and Democrats in power 50%, and you can argue the same here, really, I think the narrative was more on the liberal kind of side of thinking and trying to grow the economy, trying to have better pace of growth, but willing to allow higher inflation. And then over here, we're supposed to be even more pro-capitalism, more pro-business. We have less inflation that was supposedly a cost. We have lowered interest rates to zero, which was supposedly a cost, and we still can't grow the economy at a faster pace. Something not working well since we flipped with the symbolic election of President Reagan. And I've been on the side of, I was with the Republicans back then, but I've kind of backed away here saying, what else is there? What kind of system? And I do think the narrative here from 1980 now is that the Democrats really didn't put up the fight you would normally expect. They really didn't challenge the Republicans as much as they could have. And part of the reason I think they detected the country wanted to go that way, even some of the liberal people in the country wanted to give the conservative side a chance. I think people wanted to see, can you make money out of this? And I think over time, even the Democratic leaders were making money in their 401ks from the stock market as well. The bottom line is, I view this country as actually following the conservative narrative, not necessarily Republican, but the conservative narrative of pro-capitalism. So Republicans shouldn't be complaining and whining so much. The country was there for them. And I'm a little thinking maybe time's up, that this particular thing has burned out its usefulness and the good is going away. Okay, now let's go back up and explain these trends. What occurred is inflation actually rose during this time, from 1950s and 1980, and inflation declined. Interest rates rose and declined. The stock market rose, but it rose even faster during this decline. Okay, real estate climbed somewhat during this period and, of course, exploded in the late inflation period. And then it got hurt for a while, and pretty soon nobody cared about real estate, but it's actually returned to being better now in terms of price and valuation. In fact, I think it's overvalued, and I think we're paying way too much for rent. Okay, I think it's actually hurting the economy. But it did get on board here with a growing economy. But the point is, back here in the 50s, it's like everything went higher. Okay, and maybe that helps explain the faster GDP. And over here, we know most of the money's going to the rich, and we know some things really didn't go higher, and it's been a struggle. And by some measurements, the middle class and poor may have done better in the 50s into the 1980s, even under high inflation, even though we think of inflation as a cost. And there is a good value from inflation. So let's talk about this trend even more. We had this trend of rising inflation that went along with a faster paced growing economy. Well, inside of it, there's two phases. And the early phase is fortunately the lengthiest, the longest, the biggest portion of that overall inflation trend. And early is good, okay? Late is bad, okay? Now, we got into late inflation in the 1970s going to 1980s where we hated it. Everything was just going too high priced. Even if you were getting adjustments in your paycheck, it felt like we were only getting pay raises for nothing more than the sake of a pay raise to fight inflation. And we were losing our creativity and productivity. So the bottom line is late inflation burns out, and if it's not checked, your economy will go into hyperinflation, and it actually can explode and self-destruct. It can destroy a nation, okay? Well, isn't it interesting? The Federal Reserve understood things were getting out of hand. The system was no longer working. And isn't it interesting they hired somebody, Paul Volcker, who was really specializing in how to kill inflation. And he basically just raised interest rates that had been trying to hold back inflation or was just trying, it was a method of the financial system, the bankers trying to counter the cost of inflation. Well, he just simply used it by doing more of it to actually kill inflation. Now, of course, he threw us in a recession, hurt the economy, but that was part of the cleanup cost, okay? And then, of course, we work on lowering interest rates during what's the disinflation. So there's an inflation cycle, and we're looking at it right here. The inflation cycle breaks into inflation trend and a disinflation trend. And then inside of it, early is good, late is bad in inflation. Well, it turns out in disinflation, early is good, late is bad. By the 2000s, going into the crash for the 2008-2009 Great Recession, just before that, I think the Federal Reserve woke up. Things were not working so well. All this pro-capitalism, pro-business stuff, anti-government, small government stuff, all this fighting inflation, lowering interest rates, things were not working so well. The financial system was becoming unhinged a bit, unstable. Lo and behold, they hire someone called Ben Bernanke, who was trained in deflation depressions, things like the 1930s, the Great Depression. And he recognized that you got to save your financial system or it's just going to make a normal business consumer recession depression worse. It's more likely to throw you into a depression and perhaps a Great Depression. So Ben Bernanke just come into office in time. In fact, I think a year before the storm hit, he said everything's fine. And within a year, the storm hit, okay? So at any rate, I think what we have then is really we're due for a turn up of rate and change in GDP. There is a chance in the next 20 years, maybe we can see an improvement in GDP picking up the pace a bit. The interesting thing is, as I apply this particular cycle I'm looking at, or I'm showing you here, really is entirely separate of my business cycle modeling and the quant modeling and the trend series analysis modeling, cycle series analysis modeling, okay? And what that kind of modeling is saying is we're due for a super cycle low in interest rates this year or next, putting an end to a 40-year bear market in interest rates. In other words, dating back to 1980 high when interest rates were really high, okay? The interesting thing, it's also saying if inflation didn't bottom with the 2008-2009 Great Recession, it should bottom this year or next, alongside interest rates. So we're going to have inflation moving higher. And we're going to have interest rates moving higher, and the top is due late 2030s to early 2040s. This analysis I'm showing on this chart, just the plain inflation cycle, really doesn't give us a gauge when it'll occur. Some of these trends last 20 to 40 years, and it flips the other way, maybe 40 to 20 years, things like that, okay? We just don't know. And it looks like to me this next uptrend will be shorter, and that the cycle series analysis modeling, business cycle modeling, is forecasting it to turn that way. But it's also not allowing as much time as prior cycles. I also don't think we're going to see inflation move as high as in prior cycles and prior generations, and the same thing for interest rates. And we'll talk more about that in the future here. It really has to do with our creativity and productivity. It's like we work too hard and we don't ask for pay raises well enough and we don't get them, and we're not sharing in the bonuses as much, and the money's not circulating through the economy the way it used to. And I'm not convinced that we're going to change it back to those kind of days, and I think that's going to restrain how high inflation and interest rates can go. Nevertheless, I think they can go, and I think this decade might be that early phase, perhaps even in the early 2030s, might be that early phase I just discussed as being good. All right. So I'm hopeful the middle class and poor get a breather here, catch up a bit. I think it's okay to clip the rich and hold them back a bit. I think we need to do this because it might help temper what could be a real disaster by the 2040s. And we'll go into greater detail in some of the alternative thinking and whatnot over time here on this show, Notes from a Napkin. And I may mention some of this when we're discussing, say, just the stock market or some economic indicator. Nevertheless, I think this is a pretty fascinating story that in the 50s to 80s, we had pretty much everything going up. And now we've taken quite a few things down to neutral or slowing their pace. And yet the stock market has been the big winner. I think from 1950s, 1980s, we were more of we the people and keeping the poor, middle class, rich in line somewhat. And we wanted to break them up more with the idea of having greater freedom and getting richer and richer. And it's worked to some extent, but to some extent it has not. And I really think things are starting to deteriorate here. We need a change. So we'll see how this all works out, but that's my forecast that we're probably going to see interest rates and inflation bottom here this year or next, if inflation hasn't already bottomed. And now the key is, are we seeing some stability here in the rate of change of growth of nominal GDP per capita? And the same thing for just GDP. Can we tick it up somewhat here this decade into next? So I hope this has been a bit of interesting information for you and fascinating. Nevertheless, we can see the Great Recession causing the biggest dip in nominal GDP per capita since the Great Depression. And that's what it was supposed to be. It was the second most important supercycle downturn. It could have been much worse. I correctly forecast that the decline would not live up to its worst statistics, okay, its worst history. That the U.S., unlike many other nations around the world, could probably manage its economy and stock market better. And it turned out that way. But I also said there should be some other evidence around the world. And yes, there were some other economies hit much harder. And over in Russia, their stock market lived up to its statistical performance. It fell 85%. And stock markets around the world were supposed to fall 70 to 90%, including the U.S. But I correctly could see the machine was changing. We were going to get a little bit different supercycle statistics. But the supercycles themselves still working in terms of degree, magnitude, direction, and duration, and the timing of them. But we did get some different statistics in terms of how severe, okay? And let's hope the next more severe won't be as severe and we could sustain our system. I hope this has been some curiosity to you, and pass this video on to others. Please pass it on in its entirety and kind of respect copyrights, but I would like people to see this and listen to it and hopefully get some feedback here and suggestions. At any rate, I'm Rich Pawson for The Critical Point, and this has been a sub-show of this, Notes from a Napkin. Thank you.